Good afternoon, everyone. I'm Ashley Simpson, your host for today's webinar, Strategic Refinancing. The presenter today is Andy May, COO of AFMA Mortgage Services. We have a few slides for you today, and we'll be talking for about 20 to 30 minutes. Then Andy will answer any questions you may have. Please ask your questions by typing them into the questions block on your screen. This monthly webinar series is brought to you by AFMA Mortgage Services, LLC, a wholly owned subsidiary of AFMA, offering a full spectrum of mortgage products to the military community. Currently, we conduct business in the following 13 states: Alabama, Connecticut, Delaware, Florida, Indiana, Kansas, Maryland, North Carolina, Oklahoma, Pennsylvania, Rhode Island, Tennessee, and Virginia. And we will continue to open offices in states across the country. The AFMA Mortgage Services team consists of state licensed loan officers. Among all of our professionals, we have decades of both military and industry experience. We are an equal housing opportunity lender, and for your record, our NMLS is 1423968. As a wholly owned subsidiary of AFMA, we operate with the same values and priorities of our parent company. AFMA stands for American Armed Forces Mutual Aid Association and is the longest-standing not-for-profit association that empowers military family with affordable financial solutions. AFMA Mortgage Services accomplishes this as the premier provider of mortgage services for the military not-for-profit. This presentation is educational. It is for general information only and is not specific investment, legal, tax, or mortgage advice for any individual. Do not rely on this presentation alone to guide your home purchase or refinancing decisions. Since each individual situation is unique, the type of loan that benefits you the most will not necessarily be the same as for another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members, and to help them better understand the resources available to them. I will now go ahead and turn it over to Andy May, who will go over the agenda.
Well, thanks very much, Ashley. Welcome, everyone. We appreciate you taking time out of your day to talk about strategic refinancing. Today's agenda is talking about the types of refinances that are available, the products that you can refinance into, what a strategic refinance is, and we're terming a strategic refinance number 3 on the agenda, where you move from either a 30-year fixed into a 15-year fixed, or you move out of an adjustable rate mortgage into a fixed rate mortgage. Number 4 on the agenda, we'll be talking about the types of closing costs that are associated with the different refinances. Number 5, home equity lines of credit, HELOCs. Those are products that we do not offer here at AFMA Mortgage Services. We offer just about every other product out there in the mortgage market but HELOCs, but we wanted to talk about them as well because they should be something that you look at and think about. And number 6, the most important question, how long will you live in your home? And number 7, what will you do with the cash out? So if we move from the agenda into the types of refinancing that is available, the VA IRRRL, which is the streamlined refinance product that the VA provides, is one of the most competitive products on the marketplace. We highly recommend it if you qualify, and we're more than happy to talk to you about how to qualify for a refinance. But typically, the VA IRRRL product does not require an appraisal, and in most cases, your closing costs are around $1,000, and there is, in most cases, not a requirement to go back and re-qualify from an income basis. You will have to prove that you are employed, but you will not have to go back through the income qualification process in most cases. And a VA IRRRL is simply a rate and term refinance, meaning you're not getting cash out. So we recommend that one most highly. It's extremely competitive on the rate and even more so competitive on the closing costs. And it's a product for the military. Conventional and FHA. Conventional is Fannie Freddie. Some people are not currently in a VA and have to pay a funding fee, or it turns out that it's not as advantageous. So we also offer Fannie and Freddie and FHA refinances. And sometimes those loans come with no appraisal as well, so you save on the cost of an appraisal. We run you through our automated underwriting systems that are at the VA. We log into the VA systems, FHA with their GUS system and Fannie and Freddie, and we can run your scenarios and provide you with a loan estimate on what your costs will be. So conventional and FHA are options for those that do not want to take a look at the VA IRRRL or don't feel that that's good profitability for them. The conventional and the FHA are better. We've run them both, and we'll show you the outcomes and help you pick which one. Cash out is a type of refinance when you decide that you want cash out of your property. Typically, those interest rates are a quarter point higher than a non-cash out or a rate and term refinance. And cash out typically goes up to about $250,000. And it's obviously you can use it for just about anything from autos, college, buying a second home, doing whatever you want with your cash out. Home equity line of credit, the HELOC, is offered by many banks, and the banks, this product is not regulated in the same way that a first lien is. And by that I mean back during the crisis, there was one lender that canceled over 100,000 of the HELOCs and said you have to pay back all the money immediately. So they're under different regulations, and the guidelines are much less strict, and you are at much higher risk than with a HELOC than with a standard normal first lien mortgage. And by higher risk, I mean both in terms of the interest rate, but also in terms of the documentation and explanation of the HELOC itself. However, people use them. They're great for the lower loan balances. HELOCs typically do not go above $250,000. There are instances in which you can go above that, but typically they don't. And most people that are getting HELOCs are in the $25,000 to $50,000 range, and they're doing so in second lien position. So if you're short on cash, but in a great interest rate currently, getting a second lien HELOC is not a horrible way to go. The interest rate is uncapped, so you have to pay attention to where short-term interest rates are, because home equity lines of credit are uncapped. Some banks cap them at 16%, but I only know of one bank that does that. So APR, we put here annual percentage rate. That is basically taking all of the closing costs and amortizing them over 30 years and figuring out what interest addition would pay for the closing costs over 30 years. And for an APR, it's typically 1/8 of a point to 1/4 of a point higher than the true interest rate you get. The federal government thinks that APR is important for consumers to review. I'm not a huge fan of it in that it shows your closing costs over 30 years in the form of an interest rate, and very few people actually stay in their home 30 years. And so what I would recommend you do is find out what the true closing costs are. As we turn to the next slide, you'll find that the VA, as I said earlier, the VA and the FHA are the most favorable for getting lower closing costs. There are many lenders out there that will offer you a no closing cost loan. Those loans actually do come with closing costs. They just raise the interest rate to pay for them. So I highly recommend you find out what the closing costs are. You simply ask for a loan estimate, and within the loan estimate, they list all the closing costs. A jumbo, if you are on a greater than $424,100 loan, that puts you potentially in the jumbo market. And in the jumbo market, it's important to understand that you have more options than in the non-jumbo market. There are many more lenders with many more different combinations, such as home equity lines of credit, or they call them piggyback loans, where you do 2 loans. Rates are still extremely competitive in the jumbo market and have been coming down now for the last 5 or 6 years as we got out of the crisis. And as you can see from this slide 6, that there is a high cost area. There's about 20 of them throughout the country that the federal government has identified, and lenders go significantly higher in those markets, and they're not considered outside of the loan limits for these entities like VA, FHA, and Fannie. So as we move to slide 7, the 15-year fixed loan is something that a lot of people have been asking for, saying, I'd love to switch from a 30 to a 15 and pay off my loan a lot faster. And one of the things that I point out is that your payment will be substantially higher. If you take the exact same loan with a 30-year and switch it into a 15-year, our rates today are approximately 3.5% on a 30-year and 3% on a 15-year, and we have those rates posted at afma.com/mortgage, and you can go to see what our interest rates are on all of our products. You'll find a 62% payment increase is pretty significant, and the chance that yours is going to be that high is slim, because you will have already been in your home a while and amortized the loan balance. So it should be less than a 62% payment increase, because you will be benefiting from amortization on your last loan when you move into the 15-year fixed. So I don't suggest to everyone that they do that, but for people who are risk averse and looking for ways to move from out from a situation where they have a mortgage to having no mortgage, that's one of the options. Another option is to invest the difference, and that's something we work with you on and can show you some options. We've discussed what APR is. Again, it's important to get a loan estimate, an LE. That is where you will find out exactly what the closing costs are. And as I said earlier, if somebody says it's no closing costs, simply ask what they really are, because all they're doing is increasing your interest rate to pay for them. And as we discussed on slide 1, the most important question you need to ask yourself is, how long will you be in this home or in this mortgage? If it's less than a year, chances are you're better off doing a home equity line of credit. If you're 1 to 3 years, you should really run the numbers, and typically if you're 4 years or greater, it makes a lot of sense to move forward with a refinance if you're planning on being in your house or your mortgage 4 years or longer. Slide 8 goes through the types of closing costs that are out there. I will say they vary greatly by state and by county. In fact, they vary by mortgage program. So whether you're going with a VA IRRRL or cash out Fannie Mae, your closing costs vary considerably. These are some examples of ranges that we're putting out here. We highly recommend that you get a closing attorney. You need as many people on your side as you can. With a refinance, it's a lot simpler, but even still, with what was going on during the crisis, we still recommend that a closing attorney is involved to close your loan, to explain all the documents to you. So they typically cost around $500, although we've seen them go as high as $1,500, depending on the part of the country you're in. Title insurance, we can get you a refinance rate, which is substantially lower, somewhere around 0.2 times the loan balance, and sometimes even lower than that for a refinance. And then there's also underwriting and processing. On refinances, those typically won't show up on your closing statement because they're paid for in the interest rate, but that gives you an idea of what it really costs to underwrite a loan. And then, of course, the appraisal, if you even need one, is running around $450 to $650, depending on the size of your house and the part of the country you live in. And then there are other fees that we've listed there, but generally speaking, you're looking at as little as $1,000 to refinance your mortgage if it's a $200,000 mortgage. And if you're doing a cash out mortgage, probably somewhere around $3,000. As I mentioned earlier, home equity lines of credit come with a lot of risk. One of the nice things that they offer is typically there are no closing costs. And by no closing costs, I mean they don't charge you. They obviously exist, as we've discussed, but you're not being charged anything for the closing costs. So slide 9, I think we've talked a lot about home equity lines of credit versus refinances. We've seen a lot of people want to combine their home equity line of credit with their first lien. And yes, you can go out and get another home equity line of credit after you do the combination if you need to and if you qualify. Slide 10, how long will you live in the home or the mortgage? Most people right now are moving homes once every 10 years. It's gotten longer over time. There was a period of time where it was every 6 years, but Americans have stayed put a little more since the crisis. So how long will you live in your home? And that is a really important question. We can run the numbers for you and show you where your break-even point is. And typically, if you can save 1/4 of a point on your mortgage balance, you will save money. The question is that enough of an incentive to do a refinance? Some people like to get 3/8 of a point savings, but if you can save 1/4, you typically will save money. So we'll run the numbers for you and show it to you. We also put an example here of a 4% HELOC. Home equity lines of credit are very dependent on your credit score and your loan to value. So they do go down. I've seen them as low as 3.5 and as high as 5.5. So they've got a little bit wider spread. And obviously they're a little bit higher than first lien mortgages. Slide 11, what will you do with a cash out? That's one of the questions on the application. The interesting thing is that the underwriter really doesn't pay attention to that. I've never seen anybody get disqualified for their answer on it. So obviously buying a second home or getting a car or paying for your college, there's lots of great reasons why people need cash out, and the actual purpose is not something that usually disqualifies you unless you put something down that doesn't make any sense. So in conclusion, know what your time horizon is in your home or your mortgage, find out what your closing costs really are, and determine if moving from an adjustable rate to a fixed rate is really worth it. We've had a lot of people who are in adjustable rate mortgages that are going to reset. You should find out what your margin is. If it's 3% or greater, that's not a great margin, and you should look to refinance. If it's 2.25% or 2.5%, that's not a bad margin, and chances are that the only reason you would want to refinance on something like that is because you don't want to take the interest rate risk every year. So we're here to help you run the numbers. We're here to help you look at your options. Remember, Google is your friend. There's great articles out there on refinancing. The refinance index put out by the MBA is off about 75% from 2012 when it last hit its peak, but it is actually running pretty steadily over the last 12 months. Refinances have come off a little in the last 12 months, but not much. So it's a good time to take a look at refinancing, and if you have any questions, my information is there, and we'd be very pleased to run your numbers with you and show you what AFMA Mortgage Services can do for you. Thank you for your time, and I'll turn it back over to Ashley.
Great. So it looks like we've compiled a couple of questions But in the meantime, while Andy answers, please do not hesitate to ask more by typing them into the questions block on your screen. As the COO, Andy oversees all transactions of AMS and works from our headquarters in Fayetteville, North Carolina. Okay, so for our first question, Andy, you said the AFMA streamlined VA refinance is at a great rate. How much better is AFMA than the market?
Well, that's a great question. Our streamlined refinance, or our EARL, is something that we discount pretty heavily. And we believe that we're an eighth of a point better than all of our competitors that are out there. And in some instances, you'll find that we're as much as a half a point better in the interest rate compared to other companies serving the military.
Great. And the second question looks like our last question for now. I get mailers all the time, probably 10 or so a week. Are these refinance offers real?
Yeah, I get those mailers too. And it's crazy, some of the offers that you see on there. Some of them are true, but the requirement is that the lender has offered that product and that rate to somebody within the last 6 months. And if they've done that, then they start printing them saying that they're offering that to everybody. That doesn't necessarily mean that every lender is doing it that way, but that's how you get some crazy low interest rates that you can never get your hands on. So at AFMA Mortgage Services, we post all the rates on our website. So you can check the rates out every day or every week or however long you like. If you are thinking of refinancing and you don't like where the rate is right now and you're going to wait, it's better to get your loan application in with us now so that if rates do fall and you say, hey, I really don't want 3.5 on a 30-year fixed, I'd like 3.25, then at least we'll have your paperwork ready to go and can serve you when rates do fall. So I appreciate the questions. Thank you very much, Ashley. Are there any other questions, or were those the only two?
No, those were the only questions, but you bring up a good point for members of the audience. If we didn't fully answer your question or you think of another one later, please reach out to us at mortgage@afma.com, or you can email Andy directly at amay@afma.com. We'll go ahead and stop here, but again, reach out to us whenever you need. Please don't hesitate to ask for help because this is what we do and we love it. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And if you found the information useful, please share it with your family and friends. Our membership grows stronger every year, and it's because you introduce your eligible friends to AFMA.